If money alone created freedom, history would look very different. The richest eras would have produced the happiest societies. The most powerful men would have lived the most peaceful lives. But when you actually study financial history, you begin to notice something unsettling. Wealth and freedom are not the same thing. Income and independence are not the same thing. And working harder has never guaranteed either one. Welcome back to Smart Money History. I'm your host, Arthur. Today, we are stepping away from hype, away from market predictions, away from the latest stock trend or crypto rumor, and instead, we are going to study the 5 rules that history repeatedly proves create real wealth. These rules are not new, they are not flashy, they are not exciting, but they show up across centuries, across countries, across economic systems, and when people ignore them, they struggle. When they follow them, money tends to show up as a consequence, not as a goal, but as a byproduct. The first rule is simple, but almost nobody practices it. You must eliminate destructive debt before you attempt to build wealth. Now, this is where people get confused, because throughout history, the wealthy have used debt aggressively. Railroad tycoons used borrowed capital to lay track across continents. Real estate magnates use mortgages to control millions in property. Corporations issue bonds to expand globally. So debt itself is not the enemy. The type of debt is what matters. There's a difference between leverage that builds assets and debt that finances consumption. One creates momentum, the other creates chains. When you carry high-interest consumer debt, especially debt with interest rates above what you can reasonably earn in investments, you are fighting mathematical gravity. If you owe $10,000 at 20% interest, that is $2,000 disappearing every year. If you invest $10,000 and earn 8%, that is $800 gained. The math is unforgiving. You are losing $1,200 annually. That is not a strategy. That is self-sabotage disguised as ambition. History shows us that before families escaped poverty, before businesses scaled, before fortunes were built, liabilities were controlled. The Romans secured their borders before expanding their empire. Early industrialists stabilized cash flow before expanding factories. Stability precedes growth. And yet modern culture encourages the opposite. It encourages consumption before foundation, luxury before leverage, lifestyle before liquidity. High-interest debt steals future time. Every dollar you owe at punishing rates represents hours of your life. You will have to work just to return to zero. Financial freedom does not begin with aggressive investing. It begins with subtraction, remove the toxic variables, eliminate the obligations that multiply against you. When destructive debt is gone, your money finally works in the right direction. The second rule is equally timeless. You must build an engine, not just earn a paycheck. The middle class historically trades time for income. The wealthy build systems that produce income, whether they are present or not. English landowners built estates that generated rent for generations. American industrialists built factories that produced output continuously. Modern investors build portfolios that generate recurring cash flow. Different centuries, different tools, same principle. Ownership creates leverage. When you rely solely on earned income, you are limited by hours. When you own income-producing assets, you expand beyond time constraints. This is where many people misunderstand wealth building. They chase appreciation instead of cash flow. They buy assets hoping the price rises next year. But hope is not a strategy. During the great financial crisis of 2008, property values collapsed across much of the United States. Speculators who depended on rising prices were exposed. But something interesting happened at the same time. Rental demand increased. Families who lost homes still needed places to live. Investors with strong cash flow survived. Their tenants paid rent. Their mortgages were covered. Their operations continued. The asset price may have fallen temporarily, but the income persisted. That is the protective shield of cash flow. Appreciation is attractive, but it is unpredictable. Cash flow is stabilizing. If your investment cannot survive a downturn without increasing in price, it is not an investment. It is a bet on timing. Across history, fortunes built slowly on productive assets outlasted speculative manias. Tulip bulbs in the 1600s collapsed. Railroad stock bubbles burst. Dot-com companies evaporated. But productive farmland, well-located real estate, efficient businesses, and cash-flowing enterprises endured. The lesson is clear. Build an engine that functions in storms, not just in sunshine. Build systems that generate consistent output. When your income is diversified across assets, rather than concentrated in a job, your risk profile shifts dramatically. You move from vulnerability to resilience. The third rule is psychological, and it may be the most important. You must master your emotions before you enter markets. Financial history is not just a story of numbers, it is a story of human behavior under pressure. Booms and crashes are fueled by fear and greed. In every major market collapse, from 1929 to 2008, the pattern is similar. Prices fall. Headlines scream catastrophe. The majority panic and sell. But quietly, informed capital begins accumulating assets at discounted prices. The disciplined understand cycles. Markets expand and contract. Credit tightens and loosens. Sentiment rises and falls. Those who react emotionally tend to buy when assets are expensive and sell when they are cheap. Those who study history recognize that downturns are often periods of repricing rather than permanent destruction. In 2008, while many domestic investors froze, foreign and institutional investors studied the data. They saw oversupply, they saw forced selling, they saw mispriced assets, and they acted. Within a few years, those acquisitions generated extraordinary returns as markets recovered. The difference was not intelligence, it was emotional discipline and structural understanding. Fear feels rational during collapse. Euphoria feels rational during expansion, but history shows that both emotional extremes distort decision-making. Wealth compounds when behavior remains consistent across cycles. This is why education reduces fear. When you understand the mechanics of markets, you stop viewing downturns as apocalyptic events. You begin to see them as cyclical adjustments. The more you understand leverage, liquidity, supply and demand, and credit conditions, you react impulsively. Wealth is not built by constant action. It is built by disciplined action aligned with structural reality. Rich is a number. Wealth is composure under volatility. The fourth rule is often underestimated because it is invisible. You must respect time as your greatest asset. Compounding is not exciting. It does not trend on social media, but it quietly builds empires. An 18-year-old who purchases a modest income-producing asset and holds it for decades often outperforms someone who waits for perfect conditions. The Roman Empire did not expand overnight. It expanded steadily, strategically, and patiently. Wealth operates the same way. Early action multiplies over decades. Delayed action compresses opportunity. Every dollar invested productively buys future freedom. Every dollar spent on high-interest consumption buys temporary pleasure at permanent cost. When you examine your life over 40 years, the passage of time feels shockingly fast. Youth often assumes abundance of time. History proves otherwise. The earlier systems are built, the more margin exists for mistakes, downturns, and recalibration. Waiting for ideal conditions often means waiting indefinitely. Perfectionism delays participation. Participation fuels compounding. Time also changes risk tolerance. The longer your horizon, the more volatility you can absorb. The shorter your horizon, the more fragile your decisions become. This is why early investment matters less for immediate returns and more for structural positioning. It gives time and space to operate on your behalf. It transforms small, disciplined decisions into meaningful outcomes. The fifth and final rule is perhaps the most uncomfortable. You must remember why you are building wealth in the first place. History is filled with financially successful individuals who lost everything that truly mattered. Fortunes were built at the expense of health, relationships, and integrity. Money amplifies who you already are. It does not repair neglect. It does not restore missed years. It does not compensate for absence. Children measure love in time, not in net worth. Families measure stability in presence, not in portfolio size. True wealth builders design life intentionally. They build systems so they can step away. They create cash flow so they can reclaim time. They schedule priorities before emergencies arise. They understand that generational wealth is not simply capital transfer. It is a value transfer. Discipline, education, emotional stability, and perspective must accompany money, or money dissipates. If you eliminate destructive debt, build productive engines, master your psychology, respect time, and prioritize what truly matters, something fascinating happens. Money becomes less urgent, it becomes less emotional, it becomes a reflection of structure rather than desperation. Throughout history, wealth consistently flows toward those who build durable systems, maintain composure during cycles, and operate with long-term clarity. The patterns are repeating right now. Economic cycles are shifting, credit conditions change, asset prices fluctuate, but the underlying laws remain constant. Stability precedes growth. Cash flow protects, discipline compounds, time multiplies, purpose anchors. These are not trends, they are structural truths. So instead of chasing every headline, instead of reacting to every fluctuation, step back and examine the framework of your financial life. Are you building on subtraction first? Are you constructing an engine or simply trading hours? Are you reacting emotionally or structurally? Are you leveraging time or postponing action? Are you building wealth that enhances life or wealth that replaces it? Smart money. History exists for one reason: to study the patterns behind money so you can position yourself intelligently within them, because when you understand history, you stop chasing noise, you start recognizing cycles, you begin making decisions aligned with structure instead of sentiment. Wealth has never been accidental, it has always been architectural, and architecture requires foundation, design, discipline, patience, and purpose. The individuals who internalize these principles do not rely on luck, they rely on structure, they do not chase money, they build conditions where money becomes inevitable. I'm Arthur, and this is Smart Money History. Study the patterns, respect the cycles, build intentionally, and I will see you in the next chapter.